and Drexel Burnham.
Oh, wow. You go way back.
Yeah. I got a Drexel, literally top tick book value. I got out all my book value in the second quarter, and they failed or paid their they didn't fail, but they paid their big civil penalty in the third quarter. That was a huge exit where I got paid out 100% of my book value stock, so it was nice.
Yeah, unfortunately, I worked at Merrill Lynch Investment Managers, and so I would get paid, some comp in Merrill shares. And of course, during the financial crisis, they went from like 100 to 5 or something like that.
Yeah, I was at Merrill in '82.
Yeah, 82, I was there like 97 to, essentially till we sold ourselves to BlackRock.
Yeah.
Hey, you want to hear a good story about the brokerage business?
Yeah.
Sure.
Yeah, I got out of college in '82 and decided I wanted to become a retail stockbroker with no background in stocks. And I pitched the regional manager and affiliate, Smith Barney, and he said, "Go see my boss in New York." The boss beat the hell out of me and sent me a rejection letter the next day. But I did my research and I knew that the branch manager and affiliate ran his own P&L. So John, that guy, says, "Robert," I call him up after I get the rejection letter, and I say, "What the heck? You told me you wanted to hire me." He said, "Yeah, but Jeff, my boss said, no, you got to go sell. You got to bring rich people to the table. You're just not a good candidate." So after back and forth, I used the Hail Mary, the power close, because I had read up about closing. And I said, "John, fuck Jeff. Give me the job." And I shut up. And the first person to speak was going to lose. So after about 30, 40 seconds of total silence on the old-fashioned phone, I hear, which is very uncomfortable, by the way, I hear, "Fuck Jeff, got the job."
That's a classic tale.
I can
started in the stock business.
I can one up you. So I went to medical school and decided in my second year to leave because I was there for all the wrong reasons. Tried to get a job on Wall Street. I've got rejection notices that I could wallpaper my house with, but finally got an offer. And the only reason I got an offer is because I grew up in Boston, was a Boston Red Sox fan, and the director of research was a Boston Red Sox fan in New York City, and he needed more company. So that's why he gave me the job.
Oh.
And what year was that?
That was 1980.
I was 82.
I was-
I got started at the bottom of the bear market, 82.
Yeah, and I got hired during the recession. Which is
Isn't
not
that when
easy.
they had Carl
As a
Yastrzemski?
retail broker, I prospected Warren Buffett in 1982, but I couldn't get through to him. I got through to Boone Pickens to talk about oil stocks, but not Warren Buffett. The most obnoxious guy I ever prospected was Louis Rukeyser. I got him on the phone, if you remember the old Wall Street Week.
Yep.
Yeah, he was offended. I would dare call him stock ID as a retail stock.
I used to do some speaking stuff in my Merrill days, and he would really infuriate the crowd who had paid big money to see him be the keynote because he would not take any questions. And I asked him about it in the green room while we were prepping, and he said he never wanted to be wrong on anything, so he would not answer a question about a stock. And that's what people came for. He got roundly criticized for that.
Sounds like Ray Dalio today.
Oh, is that what he do?
Ray Dalio has never ventured a legitimate investment idea on CNBC in a decade that I can tell.
Yeah, just the macro stuff, right?
Yeah, just macro.
Yeah.
And even that's not as related to investing. It's more about the debt cycle and the economic cycle.
Yeah.
The guy's a process genius, but he's not a stock picker for sure.
Yeah.
A lot of macro guys are not stock pickers.
No,
Ben,
just me.
you have the glorious capacity for both.
Yeah, well, I trained in both, so that helps.
I'm more of a macro guy too because the banking industry has their fingers in a lot of different businesses.
Yeah, you've got to know a lot about rates.
Yeah.
Yeah, I mean, macro is pretty much rates. Like if you don't understand rates, you should not be in macro. Rates and volatility basically, and leverage. All right, I think we'll get going here. Welcome to Wall Street Beats. My name is Benjamin Brey. Hanging with the fellas today. We got the Professor Paul Meeks, Robert Marcin, our local Philadelphia Eagles fan, loving life lately, and our banking analyst is going to update us on banks, Charlie Peabody. Let's start with Charlie. It was banking conference yesterday. You were kind of updating the group on our private chat at Wall Street Beats. What do you got? What's going on there?
Yeah, I mean, we have a 2-day banking conference that ends today. It's the Goldman Sachs banking conference. And yesterday we heard from a number of the major, large cap banks, and the takeaway was very, very positive. So the guidance we got for the fourth quarter was that, capital markets are very robust. Citi talked about investment banking being up 25 to 30%. JP Morgan talked about investment banking being up 45%. On the trading front, both companies, Citi and JP Morgan, talked about trading being up mid to high teens percentage year over year. So, there's a lot of optimism. Goldman Sachs presented, they didn't give any specific guidance, but said we are in the very early innings of a revival of capital markets, and they expect, investment banking activity to exceed the 10-year average and maybe approach the levels we saw during the pandemic or post-pandemic. So very robust. Then there were a number of regional banks that talked about record NII in 25, specifically Fifth Third and PNC. And then credit quality, they all said, is very stable. No surprises there. They're buying back stock, anywhere from 3 to 5% of their stock. So it was incredibly constructive commentary that we saw. What was interesting, though, is we did see both Goldman yesterday and JP Morgan sell off on that robust commentary. And I just want to make one observation of, I think, what we wrote about earlier, last week or the week before was that, you had a phenomenal year just in the month of November alone for these banks as they really benefited from the Trump election. And so some period of consolidation or backing and filling is very justified here. And I think that's what you saw when these stocks sold off on that good news. But I expect them to continue to rally into the new year at some point. One technical observation I'd make, if you look at the XBD index, which is the broker dealer index, it's up over 50% year to date. But it's at the highest overbought weekly reading with an RSI of 84, weekly RSI of 84 in more than 27 years. So you have to go back to February of 97 to see, a more overbought situation. So obviously there was a lot of anticipation of robust news in these stocks, and that's why I think some backing and filling is possible. And the other thing is, in 2 of the last 3 weeks, this XBD index has been stuck in a trading range, and it's been closing at the lower end of the trading range. So yes, the fundamental news is very positive, but it's been anticipated. And I would say the same thing about the KRE, which is the regional bank index. Around November 25th, it failed at its 2021 high. And so, yes, the optimism about net interest income going to record levels in 25 is there, and the fundamentals support it. But a lot of that was anticipated. So backing and filling, but constructive fundamentals is the bottom line from what we're hearing from the conference. Ben, one other thing I just want to mention, after the close on Monday, Toll Brothers reported earnings, and on Tuesday it closed down about 7%. And as you may remember, one of my fundamental themes, is that things that need to be financed, such as homes, RVs, boats, they're going to disappoint. And by disappoint, what I meant was either they missed their sales targets, or in order to meet their sales targets, they're going to have to add incentives to move product off the shelf. And those incentives are going to eat away at their gross margins. And while Toll Brothers reported very good numbers, they beat on earnings and revenues. They did guide down in terms of backlog. I think they said their backlog would be down 7 to 9% in the fourth quarter, and they did guide down on their adjusted gross margins, down from 28% to 27% roughly. So that theme continues to play out. I still don't like the home builders here. And so I just wanted to update you on that. And then finally, last week or week or so ago, I said, I want to fade Bitcoin at 100,000 and buy gold. I think gold is breaking out here. The more it trades above 2,700, the more constructive that chart looks. But the silver stocks are actually starting to outperform gold stocks. And the one silver stock that I've been adding to recently is Pan American Silver, PAAS. And I urge you to take a look at that one. So that's all I have, Ben.
So Goldman, we were talking about that earlier this morning. It's kind of had that move from 510, 505, got to 590. Now it's kind of stalling out. You think that can have a retrace to like 540, 545, kind of give half the move back and then, see where it goes from there?
Yeah, it's hard to tell whether you get, a retrace or a sideways consolidation. Goldman technically, from a pure valuation point of view, if you bake in all the positives, still has another, mid to high single digit upside, in a flat market. But I'm not a big Goldman fan, quite honestly. They're trying to make the case that their fundamental P&L is much more stable than the market is giving them credit for, and because they're doing a lot of financing of these equity moves. I just don't buy into that. I think they're taking on huge counterparty risk, and if and when the markets change, and we're probably not there yet, but I think we will be there in 25. I think have issues, but right now the financing revenues, the net interest income that they're generating from supporting this market are growing quite rapidly.
Yeah, that's that fund finance group. And I know this from a personal. We have a product that we're putting out that's trades swaps and stuff, and they're definitely, if you want to do synthetics over the counter, they're the guy right now on the street. That group that you're talking about. So, but yeah, that's easy come, easy go. I don't know. What multiple do you put on that? I mean, a couple times
that's
maybe.
It comes in as net interest income, and the analyst community views net interest income as a more stable source of revenues, and that's what Goldman's trying to convince the world of, is that they have a more stable revenue source and therefore are deserving of a higher multiple. And I just don't see that as a stable revenue source. I think it's going to be much more cyclical. And then you also develop the Archegos type of counterparty risk. And I think with this market as elevated as it is, we're gonna if things turn nasty, we're gonna have more Archegos sometime in 25, 26 in my mind. So I'm not a big Goldman.
Is there more pair trade type of things in banks right now? When you look around, we've had this macro move, and it's been an unbelievable move in banks since the Silicon Valley and Credit Suisse went out in March of 23. I mean, is there a point here where banks need to have a retrace of that 70%, 80% up move?
Yeah, I mean, the risk comes in, the first 100 days of the Trump presidency, and we find out what his priorities really are. So to me, one of the big risks is that he does not cut the corporate tax rate from 21% to 15%. I mentioned previously that Besant, in his first interview after being appointed Treasury Secretary, endorsed all of the Trump tax policies in a general sense, and then highlighted the extension of the 2017 tax cuts, no taxes on Social Security income, no taxes on tips, but he did not mention specifically the corporate tax rate cut. And I thought that was interesting that he left that off his agenda. Banks pay 20 to 26% tax rates, so they're full taxpayers. So if we get a tax cut, they're big beneficiaries, and that's
Okay.
being built into the prices. So if we don't get that, then there's a setback coming.
And what would be the best way to play that then? Like, let's just say, hey, I want to have a hedge against that. Maybe I want to have it in a hot sector like banks that, if the market does roll, banks will get hit. What would be your preferred way of playing that? Is this a specific name or you do a basket? What would that be?
Well, the other group that is very overbought is the consumer finance group, which includes the credit card companies, and they are up even more than the banks. And I think their RSI is at 11-year high, 79% on a weekly basis, or 79 on a weekly basis. So that we haven't seen that RSI since June of 2013. So the credit card stocks, to me, are the way I would hedge myself, by being short them. We do get, and I'll talk about this later this week, but we do get the November delinquency and charge-off data from the master trusts on around the 15th of this month, and I'm expecting delinquency rates to continue to climb higher into the new year. So.
All right. Well, that's helpful. All right, now let's talk with Paul. He's going to pitch you on a very ugly stock chart, or at least update, let's say.
Yeah. So thank you, Benjamin. I'm here today to tell you that I'm at least sniffing around AMD. Now, I will baseline this by telling you that in my most aggressive accounts, I have a 37% weighting in NVIDIA. But AMD seems to me, and particularly after it was downgraded on Monday by Bank of America, and I can get into that, a stock that I'm going to lean into bakes on the technical analysis to tell me when the selling has been exhausted. But I do think it's overdone. And here is B of A's case. Everybody knows that AMD is a mix of CPUs, in which it competes with consumer electronics vendors like Intel, and you find those chips in things like PCs and smartphones. That business sucks. And everybody had expected that AI on board, which means AI on your PC or smartphone, was going to be a big driver. And it was going to be a big driver as soon as this Christmas. I don't think that's going to happen. I don't even think it's going to be a big driver in all of 2025. And then the other portion of the business is where the excitement lies, and that's in their AI GPU accelerator chips, the market in which NVIDIA controls at least 80% share right now. I think that as the company executes, they are supposed to do $5 billion in GPUs this year, and they're on a calendar fiscal year, whereas NVIDIA is on a January 31 fiscal. And as it becomes a more meaningful portion of their revenues, this year it's only going to be 19% of total revenues. And I do think that AMD will be able to execute. I think they're a pretty good management team. Dr. Lisa Su is the CEO, somebody I really respect, and she's an engineer. This stock will be re-rated. It'll be seen, and I think it should be seen, ultimately as a pretty good second source to NVIDIA, which will always be tops. One of the things that happened in this call by Merrill on Monday, Benjamin, is that they have a view that the world is going to work like this, that the market for GPU accelerator chips is going to be 80% controlled by NVIDIA, and that won't change. And then it's going to be 15% controlled by companies that are doing their own internal, like the titanium chip, which is Amazon's chip in conjunction with Marvell Technology. And then the last 5% might go to AMD and any other kind of upstart competitors. I think that the Merrill analyst might be right on NVIDIA and might be right on the increase in these homemade chips, but they're not going to have a 15% share. And so AMD won't be relegated to the very small slice of the pie. It will get meaningful share well beyond 5%. And that should get some excitement in the stock. So as of now, I think the stock's probably going to retrace where it was back in July and August, 121. I'd like to see it stabilize there on low volume. And then what I try to do in my portfolio is I have some momentum stocks, and I try to barbell it with a couple of turnaround situations. And I think this one very well could be because it's not the AMD of years past. That company sucked. It's actually a pretty good company, and I think they will execute on AI. And right now there's some doubts about that. And I don't think that this homemade chip market is going to be as large as Merrill thinks it's going to be. So it could be an interesting idea. Stocks trading at a very, very low, many years low peg, very, very low, many years low enterprise value to sales, which I like to look at for semiconductor names. And we'll see what happens. I think I'm going to wait for 121. If it shows some stabilization, then I probably start to dip my toe in. I don't own it yet.
So I see it's like they're going to print $3.30 this year. And so looks like 26 is $7. Is that roughly like, I mean, that's a lot of expectations of growth in the stock at this point, right?
Yeah. So I think it's probably the 330 number goes to 440, 450. I think that the number for the out year, which is $7, that number Merrill took down in their note on Monday all the way down to 5+. But anyway, I think that pretty bearish expectation from Merrill has now been printed. It's now been discussed. It's now in the stock price, and I think that they do better than that. But they may not do 7, but I don't think they're going to do 5 in 2027 either.
So you feel pretty good about a 5, and then if you put 25 on that, that's where the stock's at right now. Okay. And
well, right now, I think they can continue to, even with the legacy business, you compound their top line next couple of years, 15 to 25, and I do think that they will have some margin expansion. And so it could be attractive here.
So basically, kind of use Robert's parlance is that once they stop, once the bleeding stops, then, maybe the numbers can go up again, and maybe you get a little bit of a multiple expansion when people are excited about it again, type of like story in essence.
Yeah. And like we saw it this week, Marvell, MRVL, had their first quarter in which their AI revenues crossed over their legacy revenues, and that stock had an enormous move. And so I think AMD, I think Micron over time, right now the AI revenues are small. When they have that crossover, or we get close to that crossover, then you get the excitement. Just like many years ago, right back in 2006, Amazon introduces Amazon Web Services, and then they finally, after all the pressure from the street, break out that number, and then Amazon rockets because people say, "Oh my God, that's a good business. That's a better business than e-commerce."
Right. So like if you were to say split the difference between that $7 number I'm seeing in my Bloomberg and $5, you got $6 and maybe 30 times $180 stock. Would that be kind of a, for a longer term, like 12 to 18 months? Is that roughly?
Yeah, maybe a little bit less than that, but we're talking about a stock that before I buy it, I'm going to be getting in at about 121. So that would be great.
We're going to close for you, buddy. You keep your alert on where 128 last. All right. Well, that's good. Keep an eye on AMD. And now we're going to go to what Robert said is a potential 100 bagger, but trades on appointment, if you will.
It's a super micro nano cap.
Super micro nano.
If it were based in the U.S., the market, it's a $45 million market cap. Okay, and it trades 10,000 shares a day, so it's hard to buy. I'm
What's
in
the ticker?
Excuse me. The name of the company is Collplant. COLLPLANT. CLGN is the ticker, and it's a very unique company. They they make human collagen, which they grow inside of tobacco plants, purify it, and then apply it into biological, functions, products. So right now, that $44 million market cap, if they deliver something over 7 years, could easily be 4.4 billion. They have no real revenues today. They're in the clinic, and that's one of the reasons the stock is is because they have a joint venture with AbbVie to do dermafiller, and AbbVie has been radio silent for 6 quarters and will not let them talk about the product. So that's part of the issue. They've been sworn to silence by their premier partner, AbbVie, which owns Allergan. And Allergan has, a massive franchise in Botox and Juvederm. So that's the first company. When AbbVie announced this relationship with CollPlant, the stock hit $20 3 years ago, because that's when it was announced. It'll be 4 years ago in February, I believe. So the stock, because they've been sort of, told to stay radio silent on it. I told the CEO, I talked to him this morning from Philly. I said, you're a story stock and you're not allowed to tell your story because AbbVie won't let you. And he said, well, that's life. We needed the money then. We wanted that partner for that product. So that's what we're doing. So that's an interesting product. That's a royalty stream product. They're not going to sell it. AbbVie will come to market with the product. It'll include it in all their fillers as base. Instead of hydroloric acid, I think, which is what they use now, and it's far superior to that. But so that's the product that could be generating revenues in the next year or two for them, and they estimate $100 to $150 million in royalties over a few years if AbbVie really embraces this. So you have a $44 million market cap, $100 million in royalty payments at, whatever that is, 95% gross margins, right? So that's not the product sales. The product sales will be a lot more. Secondly, they have a breast implant product. It's like a bioprinted breast scaffold product. And they've put this into cows, and it has really shown growth and vascularization and nerve formation. So it really is a product that lets women regrow breasts. So that is going to be in the clinic in perhaps 2 years, but not available for sale if it works until probably 2030. That would be the first time you can see that. So you have a lottery ticket here on two very large and very profitable revenue stream. One in the clinic now, 6 quarters in the clinic, although they've been told to not be able to talk about what's transpiring, and then a breast product that they control that they're allowed to talk about, and they're very encouraged about how it's been working in preclinical or in the animal studies. They would hope to get that into humans, within 2 years. So it's not hard to see a 44 million. I would say my target for 4 billion is 500 million in revenue, 2/3 from breast, 1/3 from the royalties from AbbVie, and if you get 8 times sales and $500 million in 7 years, 8 years, 9 years, you'll have 100 times your money. So this is something that's going to be very challenging to buy. Don't charge into it and bid it up all crazy prices. It's not that kind of a play. You just accumulate it slowly over a period of weeks or months, and then you hold it for 7 years because that's the kind of investment. But if it goes up 50 times, 25 times, or 100 times, that's where the payoff is.
So I see they have $9 million in cash left. I mean, are they going to have to do another raise here? Are they going to get some payments in, or what's going on there?
Yeah, that's a good question. That was active topic of discussion today. They have not raised capital in 4 years. They thought they would be farther along, and they thought a year ago they thought they would not have to raise capital ever again. So that obviously shows that there's been a push to the right of the timeline. So they have enough money today to operate for the next 12 months. So they got a year in the bank, and they would hope to have a milestone payment before this time next year and reading the body language of the CEO. But if they don't get one, then they have to obviously raise capital, and $4 a share is a pretty stinky price to have to sell. But they would definitely have to do what they have to do to finish, making collaborations or their research, or they would have to do what they have to do to survive. So obviously that's an option. It's not the most likely one now, but as I said, I would not have expected them to have been in this position to begin with a year or two ago.
So if we just frame this then like an option, because it is an option, you say, hey, if things don't go right, maybe they have to raise at $2.50 to $3 in kind of a ugly scenario, and then in the good scenario they don't raise, and you kind of in this area and they start to appreciate, and you can make multiples of your time. I mean, this stock was a $1.5 billion market cap at one point in 2017. It looks like.
Yeah. So this, people have been excited about this, very excited about this in the past, and it's just so it could easily happen again. And again, it's not you don't own this just for the story. That maybe get you a double or triple. I'm not in this for 2 or 3 times my money here. This is, you got to hold this to fundamental fruition and see what happens with these 2 products.
Right. So, I mean, again, if you were saying, in the dream scenario, it's $4 billion, and it's already been 1.4. So you have 50 to 100 bagger potential. You just kind of all right, I'll risk $3.85 or again, whatever you can get it done with in the trading. But just say $4, you risk $4 to make, I don't know, hundreds of bucks basically. So,
well, that's what lottery tickets do, right?
Yeah. No, it's good to have a few of these. It's good to have a few. You don't need big sizing either, right?
You have 2 ways to win. Yeah, you have 2 ways to win. And look, I suggest that what people do is I have 20 stocks in my long portfolio, all my portfolios. That's it. That's 2 separate portfolios. And I've talked about every one but this. I've bought this for a while now. It took me months to accumulate that stinky 30,000 share position. But it's anybody could accumulate stock over time. There's no rush. I would think there's probably 3 to 6 months before there would be any news, and that would be the AbbVie study. Something would be let out publicly on that. They would get rid of the gag order they have on it, and AbbVie would talk about it. The CEO did say one thing interesting. He said, if you go into AbbVie's transcripts, you'll see they're referring to us without naming us when they talk about innovation in the aesthetics business. So I'm going to have to go through AbbVie's last few conference calls and see what he's talking about there. But the gag order clearly is depressing the stock price, because there's nothing else to talk about unless you want to talk about the breast product, which is 7 years away from commercialization.
Yeah, I mean, who knows what the world's going to look like in 7 years? But again, these kind of things have a place. You put 10 basis points in your portfolio in it, and in Robert's upside scenario, you double your whole portfolio with those 10 basis points. So just buy and forget about it is what
that's the purpose. And it's exciting. So that's the purpose. I used to not speculate because being a value guy, a deep value guy, we buy banks like Citigroup at 8 times earnings and half a book value. That's what we do, But even when you make money there, it's boring. Okay,
it is boring. I agree.
I doubled my money and I was bored to tears. I'm sorry,
and it's a very slow process.
Yes, this is something. This is not a timely trade. I can't say that there's news imminent, but it is. I think it is oversold for tax loss selling purposes. I was yelling at the CEO this morning. I told him Israel market doubled in the last year. I have 2 Israeli stocks that I've talked about here, TAT and Ceragon. They've doubled for me in the last 3 months. I said, the U.S. biotech stocks have periods where things work. And I just said, you guys got nothing, and we can't tolerate nothing anymore. So you figure out a way to get AbbVie to let you tell the stories. That's all you got to talk about. So we'll see
Right.
he said they're meeting with them, in the next couple of months. They're going to be at the J.P. Morgan, that big that big drug conference, I guess, in San Francisco every year in January. I think they're doing a presentation in New York at another analyst conference. So they're going out on the road. I mean, if you can't say anything or hint at anything, it would be kind of dumb to do that. I said you're at a J.P. Morgan healthcare conference. Is a great conference. It's too bad you can't tell anyone the story. So we'll see. He's it could be that there's news coming out in the next 3 to 6 months, and they're trying to lay the groundwork for discussing it publicly. I don't know. There's one or two analysts, third-tier analysts that follow this on the street. So you can get models, you can get Wall Street research on it, and I think the one that I shared with you a few months ago had $1 billion in revenues in 2034. So that's that, and $14.99 will get you a cup of coffee at Starbucks.
All right, and one quick. Go ahead.
Paul? Sorry.
It's getting loose in here. I was just going to give one little update. I know we've talked about Dave & Buster's on here, and Berna and Jeff had talked about it, and I've known the stock and traded it for a long time. And almost exclusively on the short side, I kind of got involved a little bit down like 30, 31 on the long side. Kind of people got excited about the turnaround. Well, that thing's getting hate sold today on a bad quarter and the CEO leaving, 3 downgrades. They negative 7.7% comps. So yeah, I think there'll be a lot of people who were loose believers in the turnaround story who probably tax loss sell this thing right into the end of the year. So keep an eye on it. That can get to $24-$25. That might be kind of an interesting level. That'd be like 8 times earnings. But I just thought I'd update that because it's down a cool 16-15% today, and we've talked about it on the show. So CEO leaving isn't great. He's leaving for European wax centers. Not sure that's like a huge upgrade, but anyway, that's all we got today on Wall Street Beats. Thank you, Paul, Robert, Charlie. Thank you, the listeners. We'll see you tomorrow.
Thank you, Ben.
Thanks, Ben.
Nice.